All right. How are you guys doing? Good, good. Good, good. Cannot complain. So today is going to be a chilled session. Yep.
To be honest, usually your classes are chilled. Yeah, you explain the stuff so nicely, everybody can just jump to the page. It's difficult to keep up.
No, it's good to hear. It's good to hear. Yeah, I appreciate that. I really do. So let's get started, eh? Just gonna put my phone here on silent quickly. As you guys now know, we have completed units 1 to 5. We're now in unit 6. Okay. So guys, like I've said, at this point in time, if you haven't gotten serious, you better get very serious very quickly. Okay, because this is where it's make or break season. Okay. So let's pull up our socks. If we're slacking, you guys know where you are. We haven't written a test yet, so I've got no clue where you are. And then yeah, let's get the job done. You want to score as high as possible with this test one, or this assignment. So that obviously you put yourself in a good footing, and you don't have too much pressure writing your first test. Okay. Yes.
I just wanted to ask, how long do the assignments usually take to finish? Because I know in about a week or two, some even start with the tests. So, well, I mean, just to have a clear idea, like maybe
what do you mean finish?
Points.
Because yours is due today.
I don't know what I mean, but how long does it have?
Oh, marking.
Next week?
I'd say give it a week and a half to get your marks. Yeah.
But that's what I just meant, so that you have an idea
of when you have your results.
Yeah. You have to cram this a bit more.
No, I hear you. So yeah, give it a week and a half. You guys are writing on your test.
No. It's the week counting, it's 19 May. 19
May. So yeah, you definitely, yeah, it's pretty close. But yeah, you should have your results by then. We'll try and make it sooner. What's good though is since we're marking online, you might be able to view your mark quite soon. I think I want to say immediately, but I'm not so sure. Yeah, because it's via VC Learn. So we'll see. Okay, all right. Otherwise, let's get into it. So today we are starting Unit 6, and Unit 6 is Inventory Systems. Okay? All right. So this is more of a recap, all right, than anything, because already we've done a lot of playing around with trading inventory, stock, or merchandise. Okay? Now, as we know, inventory is merchandise sold by a trader. If you could just check something. Okay. All right. Awesome. Okay. Just want to check if we're recording. So as we know, inventory is sold by a trading business. Okay. It's the stuff that we buy or manufacture so that we can resell it. Okay. And we know that it's also a current asset. All right. And it's expected to give us a future economic benefit. All right. If we didn't expect a future economic benefit, we wouldn't call it an asset. Okay. And then the other thing that we know is that it's controlled by the company. Like we learned when we were discussing assets, expenses, and all that other kind of stuff. We might not necessarily own the airtime. We might not necessarily own the Herbalife, but we have control to who we actually sell it to. All right? So we have control of our inventory. All right. Then, initial measurement of inventory. All right. Stock should be recognized at cost. Okay, this we also know. All right. We always have been saying trading inventory is the cost price exclusive of VAT whenever we're recording it in our books. All right, which includes all costs incurred to bring the inventory to its location and condition for sale. Okay, so we've also discussed the fact that we don't just say trading inventory is the cost of the actual good or product. No, we say that it's the cost of that plus whatever other additional costs that we incurred in order to get it ready for sale on the shelf. All right, example of additional costs to be included: transport inwards, import tariffs, insurance costs, and custom duties. Okay, then as we know, we have the perpetual inventory system and we have the periodic inventory system. All right, up until this point, we've been operating on the perpetual inventory system the whole time. Okay, we did play around with the periodic when we did the accounting equation. Okay, so it's not like it's totally unfamiliar. But getting into the perpetual inventory system, we know that it's a continuous inventory system. What do we mean by that? It allows us to continuously update, all right, balances for items of inventory. What do we mean by that? What we mean by that is that we're constantly assessing how much inventory we have. Okay, I remember I probably gave you guys the grocery store example, and with the barcodes, whenever we go to the till and we swipe something there, right, we know that that system is basically informing our inventory system that we have just sold a can of Monster, all right, and now we have 9 left. Initially we had 10, now we have 9 left. Okay, we have just sold a bag of apples. Okay, initially we had 6, now we have 5. Okay, that's the perpetual inventory system at play. It also allows the entity to determine gross margins at all times, since cost of sales is always known. Remember, cost of sales is the cost that we experience or incur whenever we've sold something. All right, so if we constantly know when we've actually sold something, then that means that we can at any given point calculate our cost of sales. Okay, and if we can calculate our cost of sales, all right, we obviously know our revenue, how much we've actually sold, then we can obviously calculate our gross profit. All right, remember, gross profit is revenue minus your cost of sales to get your gross profit. Okay, then moving on to the periodic inventory system. The outflows of inventory are not recorded at the point of sale. In other words, there's no barcode system. All right, therefore the value of items sold at cost will be determined when stock takes are done. Okay, remember, the stock takes typically only take place at the end of the financial period, whether that's the end of the month or the end of the financial year. Okay, when inventory is purchased, we debit the purchaser's account. Remember, I said this is more of a recap. All right, because remember, under the periodic, we don't have a trading inventory account, so we have to use the purchaser's account whenever we purchase trading inventory or stock or merchandise. Therefore, effectively expensed at the point of purchase. Okay, because remember, also again, under the periodic inventory system, we consider inventory to be an expense and not an asset. Under the perpetual, we look at it as an asset. Anyway, going on, it then says expenses relating to inventory such as railage, carriage, ferret, import tariffs, custom duties are debited to individual accounts. Okay, this we also know that these associated costs, which we would post to the trading inventory account if we were under the perpetual, we post to their individual expense accounts under the periodic. Okay, awesome stuff. Then this is something we haven't touched on. Okay, this is something we haven't touched on, and it's the formula for calculating cost of sales under the periodic inventory system. Okay, So if we were operating under the periodic inventory system, this is the formula that we would use to calculate our cost of sales for the year or for the month, all right, depending on when the end of the period is for us, okay? So, guys, I actually have an ICE task for you. I think it's 2 of them, actually. It might be, yeah, I think it's 2 of them. And it's based on this calculation, all right? Now, they don't usually ask this, but they could, all right? So I want you guys to obviously make sure that you know this. Now, it's not something that you have to cram. It's something that you just need to understand. Okay, beginning with my formula, the first thing that I'm looking at is opening inventory. The formula to calculate my cost of sales starts with opening inventory. Then I say to myself, did I make any additional purchases of trading inventory? Okay, that I'm going to add, all right? Then I'm going to say, did I have any purchases returns? Did I return some of the stuff that I purchased? If I returned it, then I must deduct that, okay? Then I say to myself, okay, I'm done now with whether I have any purchases or whether I return any trading inventory or stock or merchandise. Now, the next thing that I ask myself is, were there any additional associated costs to my merchandise or trading inventory to get it ready for sale? Okay, import tariffs, yada, yada, yada. Don't cram those, the whole import tariffs, carriage inwards, all that stuff. Just ask yourself, were there any additional costs in relation to bringing my inventory ready to sale? You add that in, then you say to yourself, okay, do I have any closing inventory? Okay, if you have closing inventory, you're then deducting that to get your final cost of sales on the periodic inventory system. Okay, so guys, like I said, don't cram this thing. Just understand what's going on. I start with opening inventory. I add on my purchases. If I bought any additional stuff, I must then deduct any returns, okay, that I may have had. Then I must add any associated costs to my purchases. All right, these are also associated costs. Then I must deduct finally my closing inventory. All right, and then you have your cost of sales. Okay, right. The tricky bit can be ensuring that you understand, should this be an associated cost that I include, that I add on? Should I not actually add it on? Yes, sir. That's why I give you the I stars. But in your, if you get 0, okay, that's a relevant point. That's a relevant point. So here's what we'll do. Because now obviously I want you guys to focus on, let's see, in your textbook, do they have an illustration? I don't see any. But I've seen them ask this question once or twice. Like I said, they don't usually ask it. So literally in your textbook, I don't see them ask it once. I don't see them giving an illustration. Yeah, for calculating the cost of sales under the periodic. That's also what I had. Yeah. So I think under 6.2, if you look under 6.2, question 6.2, it says, for each of the following independent scenarios, was that my phone? Sorry, I did put it on silent. So, okay. I don't know. I think that was an email from my laptop. Anyway, so here, under 6.2 it says, for each of the following independent scenarios, indicate whether or not the item will be included in the cost of trading inventory for the vendor selling the goods in question. Okay? So, the cost of transporting merchandise purchased for equivalent resale purchases or from our supplier to our premises? Yes or no? 100% yes. Wages, workers who assemble the parts of a vehicle at a vehicle manufacturer. Yes or no? So this is wages for people who are for a company that manufactures vehicles, okay? And these workers assemble the parts of a vehicle. Would that be included in your cost of sales or not? Is this company going to sell these vehicles? So this vehicles, is that their inventory? So why wouldn't it be? It's not a salary. Can you see it's wages? And can you see that if we do not pay these wages or if we do not employ these workers, we won't have vehicles to sell. Can you see that? So in other words, we won't have inventory. So can you see how it is actually a part of our inventory cost? Because we're using their labor to assemble our final product, to get it ready for sale. Does that make sense? So then this should be, that should be yes. And then the fuel for the motorcycle, which a pizza delivery man uses to deliver our pizzas to customers. 50-50 on that one. Let's just pause on that one. Let's go to the next one. Salaries for sales staff. That's a good point. That's a good point. But can we produce our final product without them? Okay. So will you guys tell me what's the answer? The answer is no. Okay. Salaries for office staff. This one is definitely no. Okay. Then cost of storing our product before it gets sold. Okay, that's another one. I'm 50-50 on. Then import tariffs paid on the imported raw material used in the manufacture of our product. Definitely yes. Okay, so now let's just quickly verify those two. Let's quickly verify those two. Question 6.2, right? Why is it taking me forever to get to 396? 396. 392 in mind. Okay. So we had, okay, so fuel was no, I thought as much. Okay, I just wasn't so sure. But I guess that makes 100% sense. That the fuel for the delivery bike is not, because if you look at it, we don't necessarily need the fuel to produce our inventory. Our inventory is the pizza. Does that make sense? That's our product. All right? Obviously, we have to deliver it to sell it, but our product is actually the pizza. All right? So that's awesome. All right, and then finally, cost of storing our product before it gets sold. Okay, that's also enough. Okay. All right. Awesome stuff. So that's the only exercise that I see they have there. I remember that the actual ice class that I gave you, I had to go and get out of another additional resource. But what I will do is just send me an email after the ice class is done. I will then go and look at the actual answers. I'll screenshot them and then share them. So that if you get 0, even though you submitted the right answers, then you know, okay, this was the working, this was the logic that I should have applied, or I did actually do the right thing. All right. So yeah, I'm just not going to give you that ice task now because right now you guys have enough to deal with, I would assume, with today being your assignment and stuff. But then let's proceed. Let's proceed. So we're going back to page 62. Sorry, 67, at least in my textbook. I think it may be a few pages further down in your guys' textbook. So it's that table that we find under the subheading, an introduction to inventory systems. An introduction to inventory systems. Okay, so we've gone through this before, but let's do it again. All right, because they say repetition is the mother of all learning. Yes, what do you want to say? 67 in my textbook is this one. Yeah. Okay. 69 in your textbook. Okay. So again, this table is literally just speaking to the differences between the periodic inventory system and the perpetual inventory system, and how we deal with inventory under the two different systems. Okay. So remember again, the whole focus of this is simply to show you how we treat the same transaction under the two different systems. Okay. And remember, when it comes to the two inventory systems, everything else stays the same. It's only when we're dealing with trading inventory and cost of sales that things start to be slightly different. Okay. Anyway, let's get into it. So first scenario, when inventory is purchased, when we buy inventory, under the perpetual inventory system, the inventory account is an asset, it is debited, owner's equity remains unaffected. Okay? Under the periodic inventory system, the purchaser's account is an expense. Remember, we recorded it under the purchaser's account, and it is debited, and owner's equity reduces. Remember, expenses reduce owner's equity. All right? And then, second scenario, when inventory is sold, we have two double entries under the perpetual inventory system. Remember, we have bank, for instance, if we bought it on cash, if we sold on cash. And then we have sales, okay? Then that's the first double entry. Then the second double entry is, remember, we have to account for the fact that trading inventory left us. So trading inventory is affected. And then the next one, the next account that's affected is obviously the cost of sales. So those are your two double entries. Under the periodic, we only have one double entry, and that is your bank and sales. We don't record trading inventory because we don't have a trading inventory account. We don't record cost of sales because we only calculate cost of sales at the end of the financial period. We only calculate how much inventory we have at the end of the financial period. Makes sense? Okay. Then, next scenario, additional costs incurred to get the trading inventory onto the shelves ready for sale. Under the perpetual, we know that we're debiting the trading inventory account, all right? Because obviously we include those costs to the trading inventory account. Under the periodic, however, we know that these are individual expense accounts, okay? And then they give you a few examples, okay? Then, trading inventory account, they're saying there, in relation to the trading inventory account, is worked in throughout the year, and the balance of the account at year end must reflect the value of trading inventory that should be on hand, in principle. Okay? Why do they say in principle? Basically, they're saying ideally, because we may make a finger error as we're recording certain transactions. So you might find that the actual trading inventory you have on hand does not match the trading inventory you have in your books. Does that make sense? Or somebody stole something. So since they stole something, obviously you don't have as much inventory as you should have. Does it make sense? Okay. Then under the perpetual inventory system, remain untouched throughout the year, okay? As all purchases are recorded, all purchases of trading inventory, that is, for stock, are recorded in the purchases account, and cost of sales is not recorded at the point of sale, okay? We know this. Then finally, cost of sales is recorded at the point of sale, thus the total cost of sales account at year end reflects the cost of sales for the year, okay? Then under the periodic, as we know, is not recorded at the point of sale, but rather determined at year end when the stock take is done. Okay. So once again, just a recap, okay? But I like to go through that just to show you guys, okay, that's where you can find the differences, and then obviously know how then to move forward accordingly when doing your exercises. Okay. So now going back to chapter 6. Going back to chapter 6, I want us to look at the illustrations there. And in my textbook, the illustrations start on page 186. So you guys, 190 for you guys. So basically, these illustrations are showing you the periodic inventory system and the perpetual inventory system, how we treat things. Okay. Under illustration 1, assume the business has 18,000 units at 1 rand per unit of their single homogeneous product on hand 1 April 2009. Basically, they're just informing you this is the opening inventory. Okay, so under the perpetual inventory system, we actually record it. Under the periodic inventory system, we record it. Okay, but remember, under the perpetual inventory system, we're constantly recording. But under the periodic, we just make this entry. We leave it until we get to the end of the financial period. Okay. Going to illustration 2. Now they move to the cash payments journal. Now, I'm just going to look at the two journals there. Under the perpetual inventory system, can you see? We have a trading inventory column. And there they say an asset. But if you look under the periodic, what do we have? An expense, which is purchases, 100%. Okay? Because we know we don't have a trading inventory account under the periodic. And this is what you guys now need to know as you prepare for your actual test. Everything that we've learned in the journals is the same, except that purchases column will be there instead of your trading inventory account. So we don't actually need to actually do the journals, okay? Let's flip to the next one, illustration 3. All right? But you just need to understand. Okay, once you understand, you'll be perfectly fine. Illustration 3, now they're looking at the creditors journal. There, again, can you see? Under the perpetual, we have trading inventory. Under the periodic, we have what? Purchases. Illustration 4, they're looking at the creditors allowance journal. Again, we have trading inventory there. Under the periodic, we have purchases returns. Can you see that? Okay, cool. Flip the page. Illustration 5. We now have the petty cash journal. Again, trading inventory there. Under the periodic, we have purchases. Okay. Illustration 6. Now we're in the general journal. Okay. And here I'll tell you what actually transpired in these transactions. On the 6th, the owner took trading inventory for himself. Okay. And then he went on to return some of the trading inventory. Okay. So, easy transaction for us. We played around with the general journal last week. We know that drawings is going to be affected, as you can see in your textbook. Trading inventory is going to be affected. And then obviously output that is going to be affected because we're reversing that input that. Make sense? Okay. We've done this. We're comfortable. Makes sense. Now, we know that on what date is this? On the 27th, the owner then returns some of this trading inventory back. Okay? So, all we need to do is reverse what we did on the 6th. Does that make sense? Literally just reverse what you did on the 6th. Okay? To the value of obviously the trading inventory that he brought back. Okay? And that's what you see there. The only different account there is input back because why? We're reversing the output back by doing a input back transaction. Simple. Okay, cool. So that's the perpetual inventory system. Let's flip the page. We now see the periodic inventory system. Can you see? There we have drawings, we have output that, okay, and then we have purchases, okay. So everything is the same. The only difference is now instead of trading inventory, we have purchases, okay. Make sense? Everybody happy? Okay, cool. Illustration 7, okay. Now we move on to the cash receipts journal, okay. And there we see that under the cash receipts journal, this is all familiar, we've seen this before, we have a cost of sales column. But then when we look under the periodic, guess what? On the next page, we don't have a cost of sales column. Why? Somebody tell me, why don't we have a cost of sales? It doesn't exist. We don't use it until we get to the end of the period, and then we say, okay, what was our cost of sales for this month? Or what was our cost of sales for the whole financial year? Does that make sense? So that's why we're not calculating it there. We're not bothered by this thing. All we want to know is, hey, how much money did we make on the sale that we made? Make sense? All right. Then next we have the debtors journal under the perpetual. Again, we have a cost of sales column, but under the periodic, what a surprise. No cost of sales column, right? Okay. Illustration 9, debtors allowance journal. We have a cost of sales column. Under the periodic inventory system, no cost of sales column. Okay. Then under illustration 10, you can see they're looking at the trading inventory account. Okay, and there you can see all the entries of everything that was done. Yeah, you can see there your other accounts that obviously affected your trading inventory. Then under the periodic, can you see? Look at your trading inventory. Can you see it's all blank? All we have is that opening balance. We haven't been recording our trading inventory or our stock movements consistently. But then look under the purchases column on the next page. The purchases account, sorry. Can you guys see that? Can you see the drawings, the bank, all that stuff? Those are all the things that would have gone under the trading inventory, under the perpetual inventory system. Under the periodic, they're all affecting the purchases. Okay? And then finally, they're showing you, in my book on page 199, the next page in your book, basically, the cost of sales calculation. All right? Because obviously still you're under the periodic inventory system. Okay? So those illustrations, if you have been practicing the journals, those illustrations are sufficient for you to understand how to do your journals under the periodic inventory system. Because can you see all we're doing here is just recognizing that instead of trading inventory, we have purchases, all right, in the journals and in the general ledger, okay? And then you're also understanding that in the journals, we don't have cost of sales, we leave it out under the periodic. Otherwise, everything else is the same, okay? So that's all that we're adding on to your knowledge from what we had already spoken about in the accounting equation in relation to the periodic inventory system, okay? Let's see, there's a few other things I just want to make mention of that I see is in your textbook in relation to this. Okay, before we get into this next slide, what's the time here? Okay, still good on time. Okay, so the other thing I just want to make you guys aware of is yeah, if you look at question 6.6 in your textbook, you look at question 6.6 and you just look at the It says research the following concepts relating to inventory valuation and make short notes about how it is applied in practice. Okay, first in, first out. Okay, it's explained in the actual wording. The first inventory that we buy is the first inventory that we want to sell. We buy any additional inventory during the course of the month. That inventory will only be sold after this first inventory that we bought. Does that make sense? Okay, so that's first in, first out. Weighted average cost. All right, weighted average cost. Here we're saying, remember, our cost of inventory is basically what did we pay for this specific inventory. All right, so going back to first in, first out, maybe let me finish that first thing. That first inventory that we bought, maybe let's say we were selling lollipops, right? Each lollipop cost us 5 Rand with that first batch of inventory. The next batch of inventory, each lollipop, the inflation, we paid 6 Rand for each of those lollipops. When we're in our books, we're going to account for each of those lollipops according to how much we paid for them, all right, on first in, first out. Now, when it comes to the weighted average cost, we will actually say, okay, we bought the first batch for 5 Rand and we bought 10 for 5 Rand. Cool. So that means we spent 50 Rand in total for the first batch of lollipops. The next batch, we bought 10 as well, but we bought them at 6 Rand. So that means we spent 60 Rand on the second batch. Then we say, okay, 50 Rand plus your 60 Rand gives you a, how much? 110. Then we say, okay, cool. What was the average cost of these? Okay, and how we do that is we say, okay, we bought 10 of at 5, we bought 10 at 6. Okay, so the weighting is 50-50. So we can actually just average this thing out all the way through. Okay, so divided by 20, what do we get? 110 divided by 20. I think it should be 550. Yeah. Okay. So our weighted cost of inventory. So when we're calculating our cost of sales, we will just say this 550 times 20 lollipops. Does that make sense? That's how you calculate then your cost of sales for the weight on the weighted average. Now, if we were actually doing it, and so if we say 20 times, yeah, that will actually get us to, it will get us to 110. But now, if we actually do it under first in, first out, when we're calculating our cost, we won't be averaging anything. We will literally just be saying, okay, the first batch, 10 times 5, 50 Rand. Second batch, 10 times 6, 60 Rand. Add that together, we still get our 110. Okay. But that's how we do that calculation. Okay, right. So I think an important thing just to note, it's not always going to add up to the same cost of sales under the two different methods, because it depends on the weighting between the stock. So for instance, if we had said we bought 5 at 5 Rand and 15 at 6 Rand, we would get a different outcome in comparison to first in, first out. Okay. So just make mental note of that. So it's important that you calculate it as you should under the different systems, because if you just calculate it saying, I did it on first in, first out, it should be the same under weighting, you might get it wrong. Okay, cool. Right, and the last thing there, specific identification method. Okay, that thing. I'm not so sure. So let's quickly see what they say under the answers there. Specific identification. Okay. Okay. Right. So in the answers, what do they say? I'm on the page there. Specific identification has been used most frequently for inventories in which the separate items are distinct and have a high cost, such as fine jewelry, because the benefit is to be gained from tracking these individual items is high. Okay, for low cost items in trading inventory, the value of such specific tracking is low unless a company is using powerful digital databases that allow detailed trading inventory tracking to be readily and cheaply accomplished. Okay, so I think here what they're basically just letting you know is under first in, first out, FIFO, or your weighted average. Here you have a homogeneous product. So for instance, earlier I spoke about energy drinks. We have Monster and we have the same flavor. Those are homogeneous. It's the same product. Does that make sense? Now, when it comes to jewelry, we have different types of jewelry. So yes, we have, let's say we're selling rings, but now we have a gold ring, all right? We have a silver ring, all right? So because of that, now you have a specific identification that takes place. And so you're obviously going to calculate the cost of these different inventories differently. Does that make sense? And that's what they're then speaking to over there. Okay. So take some time just to read the answers there, just so that you can also formulate this stuff in your own words, and also understand what is critically important there. But otherwise, that is your Unit 6. I now just want to finish up with these last 2 slides. Okay. So, which system is best? You guys tell me, which system do you think is best between the perpetual and the periodic inventory system?
Perpetual.
Mm-hmm. Anybody think periodic is better? Nobody. Okay. So yes. Yeah. So I agree with all of you, 100%. The only time where periodic would be better in my mind is if implementing the perpetual comes at a very high cost, because literally, it's setting up your barcodes, and then obviously having the software on your PCs or your devices to obviously recognize, okay, so much inventory has left, managing those, updating those softwares and packages and so forth. So it can be expensive and not everybody can afford it. So if you don't need it and it's going to be expensive for your business, then the periodic is the better option. Okay. But for the sake of simplicity and making your life easy, you would obviously want to have the periodic if you can afford it. So it is the better system. And in addition to why it is the better system is the fact that under the perpetual inventory system, remember, we're constantly assessing how much trading inventory do we have at any given point in time. So it's easy for us to quickly log into our system and say, how much trading inventory should I have? And then you say, okay, according to my system, I have 10,000 worth of trading inventory. Okay? But then, when I actually do a stock take and actually count the value of my inventory, I realize I have only 8,000. Okay? Immediately, I know there's a shortfall, okay, of 2,000. And in addition to that, I then can investigate to say, was this stolen? Did it get rotten and someone threw it away? Did the people who were delivering this trading inventory actually not deliver the full amount that we had actually ordered? So can you see, it gives me room to then investigate, and then if somebody stole it, what can I do? I can begin to put CC cameras, or I can begin to hire an extra guard. There's things that I can do, or I can fire the individual. Make sense? Under the periodic, all that we do is we say, How much inventory? Stock take. How much inventory do I have in the storage? We have no point of reference as to how much we should have in storage because we were not consistently assessing. So if somebody nicks something from the storeroom, I'm just going to assume that it was actually sold. Does that make sense? All right? So that's where the problem now comes in with the periodic inventory system. But again, I like to use the example of a dealership, a car dealership. Because, I mean, for a whole car to go missing, I mean, hey, right? I'm sure they do have some level of security. And, you know, obviously we count how many cars we have. We are aware of what's going on. So, I mean, in certain businesses still, you're kind of like, it's not really necessary for us to go that way. But I just wanted to speak to that, okay? And then here, what are they saying? So pretty much they're just saying what I just explained. So again, the reason is that under the perpetual inventory system, the balance of inventory account reflects the value one should find at the stock take if there is no stock losses. Emphasis on no stock losses, okay? Theft or obsolete inventory, okay? The difference between the balance of inventory account and the value as at the stock take can be passed as an adjustment called inventory deficits. Okay, so you guys will probably play around with this in 1B. Okay, so which is next semester. Okay, but it's obviously good for your understanding since we're dealing with the topic now. Under the periodic inventory system, there is no suggested value of inventory. Like I was saying, we don't have this reference point of 10,000. We literally just go and say, how much do we have? Okay, when we do the stock take. Where was I? And theft and stock losses and obsolete inventory will not be detected with the stock take and will thus default to cost of sales. Remember cost of sales? The cost we incur whenever we make a sale. So can you see how we're just assuming, now we probably sold it. Okay. The gross profit will thus be understated. In other words, it'll be less than what it should be under the periodic. All right. Then the net profit will still be the same. Okay. Net profit will still be the same. Net profit will still be the same. The implication is that trading inventory deficits are only prevalent, can be noticed, in other words, when the perpetual inventory system is used. The perpetual system makes it possible for a business to detect problems of theft, obsolete stock, stock losses, and this helps the strategic decision making, which is what I was talking about when I said, if I know people are stealing, if I know somebody did not deliver the amount of stuff that we should have gotten, there's some sort of recourse that I can obviously then take, okay? If I don't know, people can keep stealing, we can keep having the same problems, and I don't know how to rectify the issue, okay? Anyway, that is your unit 6, all right? So all that we're going to be doing in relation to that is then obviously those ICE costs. Okay, because this is now just application of your understanding of Unit 6. All right. I don't know if there are any questions or thoughts at this point. Otherwise, I'm going to give you guys a break. Okay, cool. So then let's take a breather, guys, and then let me see you at 9, and then we will call it a day. Just 1 second.